After such an insightful first panel, we are thrilled to bring you another exceptional group of experts for our second discussion. This session promised to be even more engaging and focuses on the topic of being challenges of running Indian long-short quant strategies live experience. I think I will now introduce and meet our panelists. So we have first one, Praveen Kumar. He is a Chief Investment Officer, AlphaGrep Investment Management. He has done his MBA from IIM Kolkata and BTech in Aerospace Engineering from IIT Kharagpur. Praveen has more than 14 years of experience in quantitative trading, portfolio management, and investment strategies across multiple asset classes. He started his career with Edelweiss Financial as part of the proprietary trading team, where he helped to set up and scale the quantitative trading desk. He then transitioned to the investment management business, where he co-managed a long-short category 3 IAF. At AlphaGrep IM, Praveen is responsible for the product and investment strategy and oversees risk and capital allocation for the Indian asset management business. Welcome, Praveen. Next up we have is Hitesh Eidnani. Hitesh runs Quantech Strategies, which is a quantitative firm that specializes in quantitative, rule-based systematic investing. Hitesh did his engineering from BITS Pilani and MBA from IIM Kolkata. He has worked with global banks and investment firms like Citigroup, HSBC, ICICI Securities, and Aditya Birla Capital. He has previously headed a team managing a prop book of more than 10 million. He has an experience of over 16 years in systematic trading across asset classes. Quantech runs domestic and global systematic strategies for global family offices, hedge funds, FPIs, asset managers, and ultra-high net individuals. With this, we welcome you. Next up we have is Rishi Kohli. We all know him because he's also the co-founder of the Laksa. So, sir, request you to be here. And guiding us through this session is our incredible moderator, Udit Sureka, currently serving as EVP and Head of Products at Nuvama Asset Services. With a distinguished career spanning over 15 years at Edelweiss, Udit brings a wealth of experience to his current role. Prior to joining Asset Services, he successfully led the structured trade finance division for the international commodities business, overseeing operations from both Dubai and Singapore. Welcome, sir. With this, I hand it over to you all for the topic.
Hello. So glad to be leading the language diversity panel, the panel in English rather than maths. But glad to be here and great to be talking to incredible people, listening to incredible people, and hopefully having some good conversation in this panel as well. So before we start, if you could quickly get some idea of what kind of long short strategies are you running, what's been your experience so far at your various firms, just to set some context.
Hi, good morning, everyone. Glad to be here. So we at AlphaGrep obviously run a bunch of different strategies, primarily on the quant side. Our largest AIF is an absolute return strategy. We also have like an equity alternative strategy as well. Apart from that, we are in the process of launching a global absolute return fund as well.
Yeah, hi everyone. So at InCred, running two funds right now. One is more on the absolute return side, and the second is also a long short, but it is a long biased, combining long equity quant models with managed futures kind of quant models. Many of you do know, I've done a lot of managed futures kind of products earlier in the past, so that's very close to my heart. So I keep combining that with a lot of different things, and that is how the product evolution is sort of happening. These two products right now, but yeah, there are one or two more that we'll launch later this year, which will again be a mix of different types of long-short quant strategies.
Hi. Oh, thanks Rishi and Pankaj for having me here. So I've basically been doing systematic quants for the last 17 years now. And currently what I'm running is divided into 3 clear baskets. So one is long short on derivatives, so primarily Nifty, Bank Nifty, mid cap, which I run for various prop desks and family offices. The second set is long only momentum in India. So I know we spoke a bit about it in the previous panel, and yeah, so that's one strategy which we have on the FPI platform. And the third one is on US ETFs. So we have levered ETFs on the NASDAQ. So we apply our trend following models on them, and that also is open for subscription for investors across the globe.
So one thing that comes up obviously a lot, especially is with long shorts, you have a better structure for managing risk maybe, right? So how's been your perception of risk in your various strategies? How does it vary, let's say, from momentum, market neutral to directional?
Yeah, so I mean, short answer is it depends, right? Like everything else. But when comparing it to, let's say, a more long-only strategy, especially in the India context, long-short strategies obviously are lower risk, right? But that doesn't mean that you can't have a higher risk category, much lower risk, let's say, arbitrage in nature. And you could also have strategies which have, say, equity levels of risk or even higher, right? So the thing is, long-short, again, is a fairly wide space. And with derivatives, you could theoretically and practically scale up risk as well. Within long-short, obviously, there are different kinds of strategies. While risks, you could look at different measures of risk. They could be comparable, but generally speaking, a lot of people will not be able to compare, say, for example, a market neutral strategy, which has, say, stock specific risks and idiosyncratic risk, versus, say, someone who's running pure options, or let's say someone like Hitesh who runs more directional managed future strategies, right? So you could compare it on numbers, but obviously there is a difference in basis on how you look at it.
Yeah, I think largely Praveen has covered it. So obviously, what has happened is that in India, so while on the fund management side, obviously some of us who have been around for some time or more experienced across different types of long short strategies, he summarized it well. The issue is on the other side, right? So the issue is on the distribution and the investor side, where I think a lot of education needs to happen. And obviously one of the goals of Laksa is that anyway. Because what happens is the moment you say long short, then all the long short funds get put into one bucket. And as he said, it can be absolute return or long only or long biased as we run. And it can be within the long biased or the absolute return. Also, there can be many different flavors. And sometimes it's not about just the best fund in that space. Sometimes it's also about diversifying across those strategies, right? So I think we are right now, obviously it's early days in India, so we are scratching the surface on that. Because that level of, even that initial level of depth is something even a lot of fund managers don't go into. Forget about the opposite side, as I said, right? So that is where I think, we need to go towards. And on the strategy side, of course, long short becomes a very, very complex world, right? So obviously we have more sessions today on long only strategies and factor strategies, etc. But actually, I mean, long short encompasses that and many other things, right? So it gets super complex. And I think most of us running multiple models in those, especially the absolute return strategies, that has its own complexity, right? Because you will not have 1 or 2 or 3 models. You will have 10, 15, 20 models. And then the question that always comes up to my mind after even 15 years is that some sort of optimization, over-optimization? I'm not, in each model, not using extra parameters, trying to control that over-optimization. But when I'm combining so many things, somewhere that is happening, right? And there's no perfect answer to it, I think, right? So you go with your experience and fine-tune these things over time as you can. And then, of course, risk management becomes important. So I think risk, because of the managed futures experience, have always looked at, Mars and CalMars and all of that. So more drawdown than volatility, unlike the rest of India, where everyone is looking at volatility and sharp. So drawdowns are important, and then the correlations, because we'll run multiple models. So then the correlations across those models, because some may be more complex models, may become almost black box. Then how do you know whether, that may be very similar to a very simple model you may have. So all of that boils down to figuring out and analyzing the correlations, and not only the overall correlations, but especially correlations in the losing periods, which again is a much more complex thing to do. But I think the more sophisticated guys do that, and we do that, and that is what will basically become very long-lasting strategy. Otherwise, there will be 2-3 year periods you'll do really well, 2-3 year periods you'll not do too well. But long-lasting, I think some of these things, if one takes care of, then it really helps.
So, coming to the panel is about the challenges and all, while risk management is one. The more beginner problem is when you're formulating your models and your strategies, what are the challenges that typical manager should expect to, or somebody entering into the space should expect to face when doing your research, building your models, and then obviously comes the question of trading as well. And you're trading, given the kind of the constructs that are available. You can have an AIF, PMS, mutual fund largely, right? These are the three main structures available in terms of managing money. And there are limitations, especially when it comes to long short, the limitations are more. So what is your advice, experience, both on the research and then the trading part of running the strategies?
So I'll take the trading side of things. Obviously on the research I have points, but maybe Rishi and Hitesh can add first. On the trading, like you rightly pointed out, the platforms that you have for long short, predominantly the AIF Cat3, to some extent maybe the PMS as well, has its own inherent set of challenges, right? So I won't get into tax at all, right? So because that's something outside of our purview. But let's say the fact that you are restricted to only India-specific securities itself becomes like a fairly large, I wouldn't say bottleneck, but something close to a challenge in that sense, right? And what I mean by that is effectively you have one tradable asset class, maybe 1.5 if you add commodity derivatives, but we all know what the challenges there are, right? So you have one effective asset class that you can trade, build your strategies, research on. And within that also the coverage or the number of securities, both in terms of breadth, as well as how many securities you have which have a reasonable amount of depth or liquidity, things like that, that is probably close to 100 at best, right? Of course it's growing, but that becomes a challenge because especially in quant strategies, these strategies, if you run things on stocks, you need more breadth because quant typically relies on like large number theories, right? So you're playing on the small edges, you need to trade those bets multiple times. So that becomes a bit of a constraint, whereas let's say if you were to trade in global markets, you have multiple asset classes, you have multiple instruments, you have much deeper markets. That becomes much easier. I think there is a point on data, but maybe I'll let Rishi or Hitesh add. Okay. So data is the other part. Obviously, as any researcher will tell you, data is a challenge, right? So anyone who's built a quant strategy will, like I would definitely pay money for someone else to take care of that data, right? Large institutional teams, even investment banks, have dedicated data teams as of now, right? So even we have a small data team who manages processes, backfills, manages corporate actions, things like that. Right, so there's an entire data engineering, data cleaning, data processing part of it. Then the other part, which is where data providers come in. I know there are quite a few here, so I don't want to take names here. But generally speaking, what happens is in quant, apart from the quality and reliability of data, which in India now is much better than where we were, say, 6 or 7 years ago, it's still not at the same level that you will see, let's say, in more developed markets for obvious reasons, which is fair. Now, the other challenge that we see in data is effectively you're not looking at only one kind of data, right? So I might be testing my strategies on, say, price volume information, but I might want to augment it with, say, some earnings, reported numbers, some sentiment scores, let's say some order book information, right? I don't think there is one data provider which you can rely on for all those different sets of data, right? So again, people might disagree, but then that generally ends up happening that you have to go to different data providers because you know broadly what each of their strengths are. So, right, so combining multiple different data sources into one coherent data set is a practical challenge. So anyone who's getting into research, before you start backtesting, what I would obviously suggest is that you look at this data cleaning part, especially when you get into, let's say, single names, stocks and things like that. This becomes a more complex challenge. If you stick to indices, obviously it's a lot more manageable to that extent.
Yeah, so Hitesh, your problem or lack of problem maybe at least on your global strategies, if you want to throw some more light on that and your experience given that you see both sides of it.
So initially when I started backtesting and trading way back in 2008, my main objective was to extract alpha both from the long and the short side of things. And I continued that endeavor for a few years. But over a period of time, I think somewhere around 2013-14, I realized that the long-term bias of the market is upwards. And if we, eliminate or reduce the requirement to make alpha from the short side of things, things become a lot easier. India is a great momentum market. Long strategies work very, very well. For a 2008 or a 2020 COVID, just to earn money from the short side, the remaining years you're going to be adding a lot of problems if you're trying to extract alpha on the short side. So point number one, I eliminated trying to make money from the short side. That was not my main objective. The way I use long short now, and in fact recently what I've added is to take care of black swan. If you're going long, say Bank Nifty, you can buy an OTM put, which would protect you from a black swan or limit your downside. But the alpha that I see is always or consistently more from the long side of things. The US market is more a mean reverting market. So, if you're trading the S&P, the Dow, a lot of mean reversion strategies would work well. But in India, I find momentum working well. So that's point number one. Regarding risk management, like Rishi mentioned, whenever I backtest a strategy, the first thing I would like to see is the year-wise return and drawdown. So I, make a simple Excel and I check the year-wise return and the drawdown across a very, very long period of time, maybe at least 15, 20 years, so that we capture all time cycles. But as Praveen was mentioning, the challenge in India is whatever you do, everything is correlated, because if the market is down, like today as we speak, Bank Nifty is also down, Nifty is also down, and the broader small mid-cap indexes are also down. So there's not much of a hedge that you can get by trading various indices. What we can do is things like asset allocation, protecting our downside by hedging. These are some of the measures that, we can incorporate as part of our risk management. And yes, the karma ratio, as Rishi mentioned, is something very, very important. Because when I'm doing derivatives, I want a non-linear kind of a return. So if my maximum drawdown in the last 20 years on notional is, say, 5%, and my average return is 15%. So I have a 3:1 kind of a ratio, which could help me in long-term compounding. But if I have something that is 1:1, then it would be more or less like a game of snakes and ladders. 1 year you make money, next year you have a drawdown, 3 years later you see you're back where you started. So that doesn't work very well from a psychological point of view.
Yeah, so I think some of the key points both Praveen and Hitesh have covered. What I would add is that on the data side, of course, as Praveen said, cleaning the data is so important. And of course, some data sources and, cleaner data is now better in India over the last few years compared to a few years back. But still there are pockets on the fundamental side. Many of you know about the challenges on some of that. On the options side, we face it, right? It's not easy to get that data. It is costly, right? So it's sometimes tough for smaller teams, startup teams to start doing that in-depth analysis. Once you've grown larger, you have lots of people, they can work on a lot of data. You can have data teams. You can spend money on the data. Otherwise, the data is really costly. So smaller teams or new teams or limited budget, you cannot really do it. So that becomes a entry barrier on its own. That is the other thing. And then, of course, the data cleanliness part of it, again, on the option side, even from data providers, it is not always fully clean. So you need to have that experience and understanding, both common sense and statistical, technical, right? Both the things to be able to really go through that data very cleanly, and then cull out the outliers and other issues that come with it. Finally, of course, let's say it's more relevant for some index options and stock options and all that. There isn't enough data, right? Now Bank Nifty Weekly has gone away, but even before that, I mean, how many years data did you really have? And how relevant would that backtest be, right? So that was the other challenge. Whereas on something like an index futures, I may have 24 years of data and very valid data, right? Which is very clean. So there I get that history, which is the most important for any quant simulation, anything you want to do. But for a lot of other things you don't. So you have that time mismatch, right? Which doesn't, you may do your walk forwards, but what use is it if half your models, there's no data only in that 10 years. So those are some critical challenges, which I think we all have our own unique tweaks to adjusting for it. But again, it's not perfect simulation anyway to begin with, right? And then when it comes to the research side, as I said earlier, long short is such a big world, right? So for example, and I know Praveen and some other funds may have more complex and more number of models compared to us. But even what we do, we have 3 buckets on our absolute return, which is stock futures, market neutral, relative value, and index FNO. Within stock futures, market neutral, we have all long short stock futures. So some may be factor-based long shorts, right? So people talked of some factors in the first session. Now we are going one step further, picking 10, 20 stocks to long, 10, 20 stocks to short on each of those factors, right? Or if it's a multi-factor model, on that multi-factor model. Then we may have many other different models which are tracking short-term momentum on a lot of stock futures, the top 100 liquid stock futures, for example. And then deciding whether to go long or short on each of them independently. And then whatever small net exposures remain, hedge it out with the index. So these are very complex. Each model itself is like a fund, right? It can be a fund of its own. And then you have these multiple buckets. In relative value, for example, we have dispersion models. Now in India, again, you don't have, let's say you want to do index Nifty, you won't have liquidity on all the stocks to begin with. So how will you really extract that alpha? You may be seeing it on paper or in your backtest, but there's not enough liquidity to go and actually implement $100, $200 million, right? You may be able to do $5, $10 million maybe. So that becomes another challenge, the scalability and the liquidity for a lot of strategies. And then, of course, what I touched upon earlier, to bring it all together. That has its own complexity and own challenges itself. So each of these are like things, you could discuss for half a day. There are so many challenges there are more challenges than easy answers here.
No, and things that are completely out of control. Let's say if single stock options start expiring a day before, right? So then your dispersion models and ability to do run dispersion models becomes even more difficult, right? So those factors are there. But purely, let's say, coming even lower down in terms of pure execution as well, and given the construct. So there are multiple issues. We've discussed some of them, and we're grappling with some of them, including like rebalancing, leverage, the way it's calculated, right? And I'm sure each of these are fairly large discussion points on their own, but briefly, let's say if Praveen, you could touch upon the issues that you face with respect to leverage, how it's calculated. Is there a better way of doing it?
So that's an interesting point. So leverage has obviously been like the bugbear for pretty much everyone here on the long short side. So yes, there is a better way. In fact, as we speak, obviously the regulator, we've spoken to the regulator, there's been some movement over there. Now the thing is, obviously with very good intent, SEBI had put these leverage constraints when things started off, say back 10, 12 years ago. Now you've had 7, 8 years at least of good track record wherein there have been no accidents, right? People might have made lower returns, but I mean, there have been no accidents. So obviously keeping things as is, this leverage constraint obviously could be relaxed. But the better way of looking at leverage primarily when it comes to non-Delta 1 instruments, right? So in India, let's say options. The reason this leverage number exists, so people look at it, is to get a sense of risk, right? So rather than use exposure as a measure of leverage, and I don't want to make it too technical for everyone here, but the better way of looking at leverage would be a risk-based metric, right? Now, how you define that, I think we are all working with the regulator to figure out how that can be done in a better way. But yes, leverage, especially for option strategies, is a challenge. And even more so when options have been pretty much the best performing strategy over the last 3-4 years. Right? So that becomes a challenge, especially on the leverage side.
Essentially, like, risk could be VAR, maximum loss, etc. So those are the
so
things
even
that you
in
have to
options,
balance.
there could be like different metrics of risk, right? So rather than look at, let's say, what happens theoretically, add up exposures for a short option and a long option. There are different ways of combining that, right? So you could look at extreme risk, but let's say in a more natural sense of where you are currently and where you could theoretically be tomorrow in that sense.
Yeah, so leverage clearly, when the 2x or 200% gross exposure limit came out in the initial AIF regulations in 2012, I believe. I was running a different firm then, and we were one of the first guys to get the AIF license. In those years when we discussed with the regulator, obviously, because it was new for India, the goal was to be conservative and go slow for the first 5-10 years. Obviously, we've come a long way since then, so I think it's a good time to sort of relook at that. And I think we've been fairly open to ideas, etc. on that. And as Praveen mentioned, various bodies and including us have, met them on this. And IVCA, for example, is doing some good work around it as well and helping discuss with the regulator on some of these aspects. So simple things like, delta adjusted exposures and other things, obviously we all look at from a practical level. I think that becomes a good starting point per se, in my opinion, practically. But of course, as both Udit and Praveen said, VAR and extreme risk and other things can be taken into account. I think from the regulator's perspective, the problem is that if it becomes too complex, either they cannot track it or each of us may have different versions or interpretations or ways to calculate it, then it doesn't work because they'll obviously need one size fits all, right, from their perspective. So I think something simpler, and which is why that initial gross exposure thing, whatever they got, made sense. But something on the delta side or net exposure side, I think makes a lot of sense from that aspect. And then the other point which Udit was asking, rebalancing, yes, so he knows this. I mean, Nuvama is our custodian for that particular fund, which is on the long only side, right? So while I said long short and other things, obviously we have this fund which has some long only quant models. And there when we are doing, say, a monthly or a quarterly rebalancing, then obviously you're exiting all the stocks today in the last 30 minutes, 1 hour, 2 hours, whatever, I mean, depending on your framework. And you, ideally, as per the model, you should be entering the new portfolio immediately, right? Which is not possible at all, the way the custody and thing works right now, because there is no net settlement allowed, right? Which is something I believe a lot of market participants, including you guys, have brought it up with the regulator and exchanges. So I think something like that will help because it's really, we've sold the stocks today, the money has to come tomorrow, right? It's not as if the money is not going to come, so it's just an operational thing. But that creates a lot of issues because we have to maybe take some other exposure index typically for that day, and then, again, enter-exit the next day. So there is slippage, there is impact, there's a mismatch for a day or two. All of those add up to obviously eroding the alpha.
So I'll just add to that point which Rishi mentions, right? So obviously this is a challenge for pretty much all long short funds. Now the reason this becomes a little more aggravated for quant ones is generally we have, let's say, higher turnover strategies in that sense, right? So for higher turnover strategies, if you don't execute on the pretty much the same day, that slippage kind of becomes a larger component as such.
So, moving on to the other parts of it, and we touched upon it in the previous panel as well a little bit, is, basically when it comes down to marketing and explaining, and the biggest channel is obviously through distributors. You're talking to some large investors directly, but in both these cases, what's been the experience in terms of being able to explain the various contours of, different long-short strategies, quant models, the fact there are multiple models within it, and how, what is your experience in terms of how it is perceived, and how is it further marketed to investors?
Yeah, so very tough, obviously. The long buy strategy will be, compared to long only. And the moment you say that in the large falls, you're going to fall lesser, they're going to think every 3% fall, you're going to fall lesser, which is virtually impossible, right? So now what is the definition of that large fall? When you say, like I say, when there are tail moves and the downward momentum continues, then I will perform better, for example. Now, what is that definition of downward momentum? We'll let the next panel discuss that. But these are all very challenging things with the investors. And even on the absolute return side, as I briefly mentioned earlier, also, clubbing all of them together. Now, someone is trading options, and like I said, we are very, very diversified. It's not the right comparison anyway to begin with. And in my opinion, so if, I have my money allocated, I would allocate it to 2 or 3 funds in that space, never to one, because each of them have their own benefits and each of them have their own risks, right? Like we all know, there is a black swan, there is uncertainty around the corner. So however consistent one may have been, there will be some risk pain point of that model or that strategy at some point. So to diversify from that, allocating across a few, sensible people, implementing things in a sensible way and having very differentiated strategies, I think is the right way to go. But even that, unfortunately, understanding, even whether it's at the wealth manager distributor level or at the end investor, HNI, family office level, is not there. So, in fact, I have given this idea to some of my wealth management or distributor friends who are like running smaller shops or independent shops, that actually it's the need of the hour that there is one wealth manager which only focuses on quant funds and really understands the nuances around that. I think there is a very big scope at this point in time. And none of the large wealth guys have enough people who understand it.
Bit of a chicken and egg problem, right? Once it becomes large enough, then you get allocated resources to solving that problem. But it's going to come about eventually. Space is growing. Also, essentially right now what we're doing is generally raising the problems. Hopefully some of the other panels discuss more of the solutions. Investor education is obviously one part of it, which I assume, will be one of the goals for Laksa as well going forward. The second part is, getting the people to do the job, right? So in terms of hiring talent, what's been the experience, getting the right amount of talent, and also, you're obviously competing when you're running a fund versus, let's say, being part of a prop shop. So what's been your experience and advice to young professionals when they're choosing whether to, choose a prop shop or the fund? Praveen will have a slightly unique view on it, right?
Yeah, AlphaGrep is both, so.
AlphaGrep is both, but I am not. But of course, I've worked on both sides of the business, right? So to be honest, in India, as of now, talent is limited, right? And because there is scarcity, there is a huge supply-demand kind of a mismatch, right? So there are a few people, and I'm talking more about people with experience of running strategies, right? So there is a clear mismatch of talent on that side, and there are a lot of global players who've now started coming in and setting up shop in India. India is no longer a very small market. It's got sizable opportunities. I think everyone has seen that in papers as well. What ends up happening for juniors or maybe like fresher hires, there you're competing because you're looking at a lot of computing talent. You're competing with the likes of the Metas and the Googles of the world, right? So again, your competition or your opportunity cost in that sense is fairly high. That is on the talent side of things. In terms of what I would advise maybe someone to start off with, I think there are 2 parts to this. The advantage of obviously being in a prop shop is you're a lot more nimble. Pretty much by definition, you can start, experiment, keep churning things out. So you're almost like in a lab. Obviously, you have limited lifespan if you don't succeed. But you can experiment a lot more in a prop setup. In an asset management or in an investment management setup, obviously you need to come up with more scalable kind of ideas. And therein lies the opportunity cost for someone who's looking at A versus B. In prop, you might be able to run, let's say, smaller strategies. Your take rates might be much higher. But the way asset management competes globally with prop shops is because you obviously have much larger pools of capital, right? So beyond like a 5-6x kind of an AUM threshold, I mean, I as an individual, if I am a portfolio manager, I become indifferent in that sense.
Yeah, I think Praveen has covered most of the pointers here, and obviously it also a little bit depends on your mindset, right? So, someone who prefers working completely on his own, I think, that also tilts him towards the prop side a little bit. And of course, the scale part he mentioned is perfect because you can only do certain things at scale in an asset management firm. And of course, you even if you are given your silo there and to do your own research, which also can happen in an asset management shop, it isn't as if it cannot, but still somewhere you'll need to interface with some other people, some other teams, etc. So as long as you're open to that, it becomes interesting. And obviously doing things at scale and then meeting some of the people. So if you have a little bit of a flair on, you want to meet investors, understand that psyche, etc., or meet other fund managers, then that becomes interesting also from the asset management side. Those are the two additional things I would point out.
No, I think most of the points have been covered, and I think it really boils down to the individual. But I've worked on both sides with props and funds, and I continue to do so. My personal experience is that if you have a strategy which genuinely has some alpha, I think working on the prop side is a lot easier on your psyche, and also from a long-term running of that strategy, because running a fund, the requirements are going to be a lot more stringent, whereas in a prop, there could be a lot more relaxation of, going through a tougher periods, lumpy returns, those kind of things. So that's just been my experience.
Right, I think we've covered most of what we wanted to discuss. We've got time for a few questions. So if there are any questions.
Someone can rotate, Priyanka can rotate the mic.
Check. Yeah. This is more for Rishi and Hitesh, who've been running a long shot in India for a very long time. A lot of people who want to get into this industry pretty much know their stop losses. And, when you run these models, you know your stop losses. Having run these models in India, I'd like to know how does your model kind of interpret, when do I get out of these long short strategies? Is it like a profit-driven target or is it a momentum-driven? So when you run these strategies, how do you determine when do I book my profits? It's fairly easy to understand when do I book my loss. So I'm trying to understand that you've done this in India. So what are the key factors, or when you do these quant models, what have you looked at to find this is where I book my profit?
So what I run is completely 100% systematic. So the model itself tells you, when to enter a trade, when to stop a trade. I also have a volatility filter. So when things get volatile, that's during those periods I stop trading. So, nothing is dependent on my personal emotion at that particular day. I mean, I could be having a very bad day, and I decide rates are spiking up, let me stop trading. So, all those things don't come into my personal trading. Everything is decided by the model itself.
Yeah, so for me, of course, it's depending on the model, right? Different models have different ways of doing it. And, some may have profit objectives, again, based on its own rules and simulation and whatever else. Some may not have that. Some may have a switch of the signal or a change of the signal or something like that. But interestingly, as I mentioned earlier, the interfacing of all of that. So how all of them combine together and how those correlations change around, that becomes important for me, which is a much more complex thing to obviously do. But interestingly, since you asked the question, I just realized, we haven't discussed this, but what is the most important is how to gauge that the alpha decay of the model has happened, right? And it's gone. That again is very, very tricky, but there are ways to statistically to sort of at least get some heads up on that, right? So you can have certain metrics and see that they are completely outliers based on your statistical modeling. And if 2-3 of those, let's say in simple things, if I want to highlight it from a trader language, then let's say your win-loss sequences, your drawdown sequences, if a lot of these are completely outlier from a statistical perspective and a lot of them are happening together, then that gives you some indication that, the model is going for a toss or there's an alpha decay or it should be stopped. In my 15 years on the buy side, or more actually, 16 years, once it's happened. So there was a model in Japan which I closed, but other than that, it's not very common. It just goes in and out of favorable and non-favorable patches. But yeah, there can be statistical ways to define that, which I think is very important for long shot.
So one more last question.
Hello, I'm audible? Yeah. So basically, I had a more technical question. So basically, let's assume we have developed a signal S, right? And we have low, basically, signal to noise ratio. Then, so we have methods like Karma filter, or we can go with wavelet transform or simple moving average. So as per you, in your experience, which method have been more useful and which has given better results as for you for this, without losing the predictive power of the signal?
So, I mean, between the two, it's difficult to pick. Generally speaking, what we've seen, and this is more from experience rather than statistical data as such, the simpler the signal, the more likely it is to sustain over time, right? So,
Very good.
right? So, if you, I mean, generally you look about things, especially as a researcher, when you compute a signal or you design a signal, what you should ideally look at is how can you break that down into more easier signals, right? So if you have, let's say, I mean, people talk about, let's say, different ways of calculating moving averages. There's an exponential average, there are different kinds of averages and things like that, right? What you should start with is comparing or benchmarking that against the most simple signal, which is a simple moving average. How much alpha are you getting per unit of additional complexity that you're adding? So that's how you would start. Now, to complete the answer, obviously the way to look at it is if you have a lot of weak signals, the way generally a lot of the models that we use also work are we combine a lot of these weak signals and effectively it's more like a meta model that you eventually come up with, right? So there are two ways of going about this. One, you could develop 100 weak predictors or you could develop one very strong predictor. I think it's easier to develop 100 of those weaker predictors and then combine them rather than try to go for that one moonshot as such. That's my take.
Can I have a follow-up question on the same thing? Yeah. So like you said, we can take a strong signal or we can go with 100 weak signals, right? So can you just tell more about the trade-off between choosing both the option, right? Like what can be the major trade-off while going with one strong signal and while going with hundreds of small signals?
So I think I can discuss that, but maybe it's better if we take it offline so we can continue after that.
And I just wanted to end with a sort of a joke, right? Pankaj and I have been discussing some jokes around statistics since yesterday. So who is a statistician? Someone who insists on being certain about uncertainty, right? So some of these things we're discussing are almost bordering on that. So I would say we'll keep discussing offline.
Yeah. Thanks, everyone. So, basically the point to this panel was also to bring out some of the points. A lot of you may be managing money, managing strategies. It's a slightly different game when you come to managing a fund or running a fund. So the other operational parts, that you would typically not have dealt with around, let's say, accounting, taxation, onboarding of clients, all of that become also important. And those are also considerations when getting into the fund management side of it, or when you're starting your journey, towards fund management, away from money management, right? And that's where we kind of, have been trying to help, both on the FPI side of it, getting them into the country, and on the domestic side in terms of, even sometimes starting the engagement as soon as the, somebody starts conceptualizing the fund, how are the strategies going to run, what kind of strategies, and then, bringing in tools to help with accounting for it, dealing with taxation, onboarding of clients, all of it. So if you're looking at starting that journey, get in touch with us. We'll be happy to help out and partner there. Thank you.
Great. Thank you so much to our second set of panelists. I think before you all go, we again have the gifts ready. So, Mr. Pankaj, could you please come on the stage and hand it over to them? Thank you so much.